Hello and welcome to All Talks with Cafemutual. I'm Ridhima Bhatnagar. Today we have here with us Vikaas Sachdeva, who is the MD of Sundaram Alternates. Hello, sir. Pleasure to have you here.
Thank you, Fred.
So I want to start by asking you that in category 1 and 2, private equity and venture capital funds have been giving returns up to 18 to 20%, which is, as per data, lesser than few of the equity funds. So why do you think that investors should look at this unlisted space?
Well, let me talk to you about CAT 2 because CAT 1 I'm not really tracking. See, returns, there are two aspects of returns. One is in what time frame do you look at the returns? At different time frames, you'll find that different products perform differently. So if you take it as on a period of time, you will probably realize that some asset classes are doing well or some equity classes are doing well and some are not. So I won't be too worried about that because I think at the end of the day, the second question which you talked about, why do people invest in unlisted equity? I think that is more important. You are getting early stage exposure to companies who are at a very initial stage of their growth, okay, and they're expected to grow manifold. If you see some of the companies which have got listed recently, just to name Zomatos of the world and Olas of the world, I'm just taking a couple of examples. There are several other companies in the crime sector, in the manufacturing sector, which have got private equity funding and have now gone public. Okay, there are manifold increase which happens. So these are different stages at which you come in. So I for one am very bullish on the unlisted equity structure segment. The only thing one has to be clear about is that the access to information is going to be limited as compared to listed. So it's more of what your understanding, your knowledge, your perspective on the company and the promoter is, rather than what the actual data is. So I think that is where most people go wrong. They either get too carried away by the data or they ignore certain green shoots, which might be very, very beneficial for them later on.
So equity, PMS, and category 3 AIF are similar to mutual funds. So why do you think that AIF and PMS offer diversity to an investor?
Okay, so I hope there was a comma between PMS and category 3, right? Okay, because these are two different products. I think some speakers in the session spoke very extensively about PMS, but from my side, apart from a lot of benefits which PMS brings, the biggest advantage or the biggest USP of PMS is the emotional engagement it has with the investor. You see, when you buy a mutual fund or an AIF, you're buying a unit. But when you're buying a PMS, you're buying a security directly. A security comes into your portfolio, goes out of your portfolio, you get messages from the exchange. There's a huge amount of emotional, investment the client makes. And these are usually concentrated portfolios. I would dare say that some of the benchmarks which have come into vogue right now are not representative of what the quality of the portfolio is. There are three standard benchmarks. So that's why when you compare the portfolio to the benchmark, there are two things which will happen. One is if the benchmark is not relevant enough, then you will see sharp outperformances, underperformances. And two, if the portfolios are slightly concentrated, at the end of the day, you're trying to buy the market, you're trying to beat the market, not buy the market. So if you're trying to beat the market, at times you'll get beaten. So concentrated portfolios have that little bit of volatility, but over a period of time, if you're sticking to either quality as a factor or value as a factor, you will tend to outperform the benchmark very substantially. Like I said, it's just a matter of what time horizon you're looking at in terms of data analysis. You talked about CAT 3 AIFs. The normal perception is that CAT 3 AIFs are only equity. In fact, most of them are equity, but CAT 3 is a platform which you can indulge in for amazingly complex and leveraged strategies. You can have long short, you can have debt, you can have market neutral, absolute return, a host of strategies which are coming in CAT 3. So again, this in terms of returns, the same logic holds true. It is just in a matter of time, a matter of what time horizon you're looking at. But I, for one, would think that CAT 3 is a great platform for investors who understand the trade-off between liquidity and returns. They understand risk-adjusted returns. There are a bunch of thousand odd investors which come in to get into a particular strategy, and it suits them. So I think it's a very different sort of a mindset when you invest in a Cat 3 AIS.
What are some of the popular strategies of category 3 AIF and PMS?
Category 3, like I said, the most popular is long only, but I think increasingly, incrementally, there are a lot more differentiated strategies coming in. A lot of AIF fund managers are now launching debt AIFs. Okay, so that's something which is quite convenient because these are listed securities, and the other thing is Cat 3, you have open-end AIFs, so it's not just a closed-ended structure. So it's pretty much like a mutual fund from that point of view in terms of liquidity, etc., or rather open-endedness. But you can indulge in different types of strategies in an open-end platform. PMS, again, one of the more interesting things which is happening is debt PMS. We are one of the few large manufacturers which has launched a debt PMS. And this whole arbitrage of indexation, which has now gone away from the mutual fund industry, opens the door up to products for like debt PMS for an average investor.
And my last question to you is that there are so many strategies in AIFs and PMS. How does a wealth manager shortlist them for the investors?
Uh, See, first of all, the wealth manager has to be certified, trained. You just can't get into this and say, okay, from tomorrow I'm going to start selling AIFs or PMS. Like you pointed out, tremendous number of strategies, tons of manufacturers, different types of products which are out there. At the end of the day, if you take a product and try to sell to an investor, then you're letting the tail wag the dog. Okay, it has to be the other way around. You have to understand what the investor wants. Okay, what is his risk profile, what will work for him, not work for him, what his overall objective is. His objective could be capital preservation, his objective could be growth, and then take products which suit him. Now you might just find that, for example, in investors portfolio there are products like a mutual fund or bonds. I'm just taking some examples. So you may not necessarily need an AIF product for him. So that sort of understanding and maturity an advisor should have. And AIF, an alternate product, is a complementary product. It is not a substitute product. It is part of an investor's asset allocation. It is not the asset allocation.
Thank you so much, Vikas, for that insightful session. That was all from today's edition. Thank you.